Now, investing in the stock market is a viable strategy, but it requires careful planning, discipline, and long-term perspective. And here on this video today, I want to give you a step-by-step guide to help you achieve retirement through stock market investments. Now, stock market is a place where investors connect to buy shares of their choice with the primary objective of generating tons and tons of money. I have spoken what the stock market is all about. I have given you what is the best strategies for beginners. I have covered that on this channel, and today I want to give you the 11 steps that can help you retire by just investing in the stock market. This, I must say, it takes discipline and it takes commitment, your full commitment, if you want to take it to the next level. I'm not yet there, but this is what I'm using, this is what I'm doing on a month to month. When I get my paycheck, when I get my other incomes, I'm all in the stock market because I want to get or reach financial freedom. Now, without wasting any more of your time, step number one that you need to follow if you want to reach financial freedom by investing in the stock market is that you need to set clear retirement goals and determine your retirement age. So you need to have a clear goals as to where do you want to be and by when. So if you want to retire at 50, you must calculate how much it will take you to get there. In terms of your expenses, how are your expenses looking like? You need to calculate how much you need to get there. Calculate your expenses. This includes housing, healthcare, travel, and other costs that you might incur during your retirement. You'll need to calculate the amount of money you need to save or you need to invest to support your retirement lifestyle. But the good thing, like I said, it is doable. This is exactly what I am doing. We have seen quite a number of people doing this. I think it's possible for me, it's possible for you. We can all use investing in the stock market as a way that takes us to early retirement, right? Now, number two, you need to understand your risk tolerance. As I've said, I think I've said this in quite a number of videos to say that, of course, when you're investing in the stock market, you need to understand your risk tolerance. Me, I'm more into growth than into dividends, but I also have got few dividend stocks in my portfolio, and by this it means that I'm more aggressive into buying stocks for capital gains than, of course, chasing dividends. And this is because I want to get to see my money growing more and faster so that I can get to my target for retirement faster. And this is why I go for growth stocks, right? And growth stocks, you know that picking individual growth stocks, of course, has got its advantages and disadvantages. The advantage is that you can be able to generate money quite fast, but you can also manage to lose the value of your money quite fast. You just need to know what you're doing. You need to know that your analysis onto various companies is quite sharp, but you must know your risk tolerance. What are you investing in? If you are a person that, of course, you don't like that much of risks, then maybe you can consider going and buying ETFs like the S&P 500, which track the top 500 companies in the US, or you go and buy the JSE Top 40, which tracks the top 40 companies in the South African market, which is something that also will be very good for you, because I think the last time I checked, on average, S&P 500 will give you like what, 10 to 12% annually on average, which is a very good growth because it will be compounding with time, which is something that is pretty good, pretty decent. So you need to understand your risk tolerance when you are investing or as you start your investing journey. Understanding risk tolerance also, it means diversification of your portfolio. You need to not only invest into local stocks, but you need to also look into going overseas and investing into overseas stocks. So which is why I made an example just now about the S&P 500 and the JSE Top 40, which these two give you exposure in the US and in South Africa, which that will be one of the best routes to use. But if you want to take it to the next level, you can also go for individual stocks. But individual stocks, like I always say, you need to make sure that your analysis is point on, and you need to know what is happening around that company, which is very, very important, because you don't want to find yourself putting a lot of money onto a certain stock, then you lose that money and you never recover. That is something that you don't want, because it will drag you or take you a lot of time for you to obviously get to financial freedom or retire early through the stock market. So you need to make sure that you diversify your portfolio, and there is a balance in your portfolio. There's a balance on ETFs, there's a balance on value stocks, there's a balance on growth stocks. But again, you can make growth stocks to be to weigh more than your value stocks or your dividend stocks. You can make your ETFs to weigh more than all the other stocks in your portfolio, being it value and growth stocks. It depends on your risk tolerance, right? You can invest more in the US than in South Africa. You can do that also. It depends on how you are strategizing, but this is what you need to do in terms of your planning, or when you are planning to going and retire through the stock market. Step number 3, you need to invest as early as possible and invest regularly. So once you start your investing journey, if you are putting a certain amount of money on a month to month on your investing portfolio to buy shares, to buy ETFs and all the other asset classes, this is what will make you get to the next level. Because investing this month and not investing next month, it will of course delay you to get to where you want to be. But if you are setting aside a goal, or setting, maybe saying you are going to invest 20% of your salary, 10 to 20% of your salary into stocks, and you do that consistently, that will of course improve and make you to get to your goals or financial goals much quicker. I mean, compound interest is the key, right? Because as you are continuously investing, you'll make interest on top of interest. As you are investing, you'll make money on top of interest. And this is the magic that some of the investors or big investors got to reach financial freedom, using compound interest on top of interest, which is one of the better ways to get to financial freedom. So you need to invest regularly in order for you to generate good interest on your investments or stocks, ETFs that you own. Step number 4, you need to choose the right broker. Make sure that the broker that you choose, you can afford their service fees, which is very, very important, because you remember the primary reason why you're investing is to make money. So if you choose a broker that is taking a lot of fees from you, it ends up not serving a purpose. So finding a broker that can obviously make you not spend that much on the platform, it's always good. And the brokers specifically that have like accounts like tax-free savings account, which allows you to invest into various ETF baskets without being taxed. I think annually you can contribute 36,000 on your tax-free savings account, and the interest that you make, you don't have to sort out SARS, which obviously it's important that you find brokers that can give you this kind of accounts that can easily take you to the next level when it comes to your finances, right? Step number 5, you need to, when you are selecting individual stocks, you need to make sure that you are selecting stocks that obviously are set for greatness, right? And these can be blue chip stocks. These are the companies that are well established and they've been doing pretty well for years and years. These are the companies that of course they have got stable performance, and maybe they can pay you some dividends, which is good. Growth stocks, you need to also have growth stocks, because growth stocks, these are the companies that are found in industries which are expected to grow much more faster than the normal growth that you see on the S&P 500, which is like what, 10, 12, 15% per year. These are industries where, like I said, they are expected to do very well, and you need to find yourself also investing into those stocks so that you can gain a lot of capital, you can see a lot of capital appreciation from your stocks. Number 3, you need to have dividend stocks. Dividend stocks, these are the stocks that of course they've been in the game for quite some time, and there's not much growth they can see in the future, and therefore what do they do with the profits that they generate? They always give it out to investors. That is what keeps investors from staying with the company, because of the massive dividends they continue giving to the investors. Coca-Cola is one of the companies that pays dividends. An investor of all time, Warren Buffett, it's one of the companies that paid him, or that took his company Berkshire Hathaway to where it is, because he bought Coca-Cola a long time ago, and now Coca-Cola is paying him quite huge amounts of money every time they pay dividends, which is something that shows you that dividends is very important, because it is free money that the company is giving you as an acknowledgement of you owning their company, which is a very good thing. Now, step number 6, diversification of your portfolio. It's not just about buying South African shares. There are local platforms or broker platforms that are giving us opportunities to buy stocks in the US, buy stocks in the UK and other countries, and you need to take take that into cognizance, because that is very important, because it helps you diversify your portfolio. If something is to happen in South Africa and stocks in South Africa are not doing that well, you know you've got US stocks on your portfolio, so that will help to balance out or continue maybe giving you the kind of growth that impresses you on your portfolio, which is something that is very, very important. Another thing that is important is the sector. Don't just invest into one sector, invest into various sectors, so that when things or when bad things hit a certain sector, you know you are not worried that much, because you have invested, you have put your eggs into quite number of baskets, which is what will make you not to stress that much. Because if you are to put your money into the mining stocks only, right now, due to load shedding, mining stocks might struggle a bit in terms of the production, they might struggle a bit in terms of the profits they generate, which therefore, if you are into mining only, you might face a serious hit, or it might be quite consequential for you deciding to do that, because with load shedding, we know that those companies, they don't perform well, which is something that you need to have at the back of your mind, and therefore encourages you to diversify into various sectors. Now, step number 7, monitor and rebalance your portfolio. Now, as you are investing into these stocks, of course, there are targets. Let's say a stock that you bought doubled your money. I don't think it will be good for you to try to get another maybe 300% onto that stock. You must try, even though you are not selling it completely, you must try to maybe trim your profits and go look for other opportunities, so that you can rebalance your portfolio. You can allocate and look for more opportunities that will even take your portfolio to the next level. Yes, there are stocks that will give you 1000% in 5 years. We have seen that, but those stocks are not guaranteed. You cannot say, no one had a crystal ball to say that Tesla in the last 5 years would see their stock price going up maybe by over 300% or over 500%. But obviously, for you to try to grow your portfolio, you need, when you see 100%, this is what I do. I try to trim a bit my holdings and go look for other opportunities, go look for other investments that I can put the money to, so that I can try to always rebalance, and also maybe go and help assist those stocks that are not performing that good in terms of the share price in my portfolio, by increasing my holdings if it makes sense, or if I have analyzed and it makes sense for me to increase my holdings onto those stocks. So it is important that you monitor and rebalance your portfolio. Now, step number 8, you need to stay informed all the time, right? Because investing, and you are not reading about that company, you are not reading about what is happening in the country where you are investing, or where some of your stocks that are in your portfolio are from that country, it is not good, because the next things happen and the market crashes, you are on a red, right? So or things happen, that company you own is delisting and you lose money. It happens, especially in SA, JSE. We have seen quite a number of stocks being temporarily suspended in the JSE or trading in the Johannesburg Stock Exchange, which is not good. And this, you can avoid such things by always being aware of what is happening in the country, always being aware of what is happening onto that stock, because things don't just come. There are always signs to say that this might not be a good stock anymore, or I might have to sell at a loss and go and look for other opportunities. You need to always be knowledgeable of what is happening around the stocks that you own, what is happening around the companies that you own, and also the country. Step number 9, plan for taxes and invest, or tax efficient investing is also very encouraged, which is why I was talking about the tax-free savings account, which tax-free savings account are very important, because there, man, it's like you are investing and you won't be charged for the capital gains you see, provided you are within the requirements, which is something that is very, very good. And I think everyone who is investing in the stock market, they should take advantage of this and invest into ETFs that are found within the TFSA account, right? It's very, very important, guys, because you will know that from the profits that you generate from individual stocks, you need to pay SARS. SARS needs to get their portion, because every returns, every profits you make, you need to take part of those profits to SARS, because that's capital gains, right? We will talk about capital gains I'll try to make a video about capital gains as time goes, and we just talk about the tax. What are some of the tax implications that you come across or that you need to take into cognizance as you are investing into the stock market? But for now, you need to also have that at the back of your mind as you are planning to retire through the stock market. Step number 10 is that if you don't understand, seek professional financial advice. Go to professional advisors, go and get advice as to how you can build your portfolio better. Even if you are still managing your portfolio, if you can't manage, you can give it to them. But if you can, even if you are managing, if you get stuck, it's always good that you go visit the professional financial advisors so that they give you guidance on how to do it better. You might not be doing it right, and therefore a professional financial advisor might give you a better direction on how you can do it, or how you can invest into stock and get to financial freedom. Now, the last step is preparing on your transaction. How do you plan on withdrawing your money when you get or when you meet your target? It's very, very important, because you need to also look at things like tax. You need to also look at how you can continue making money from your investments, because I don't think if you are planning to retire through the stock market at the age of 50, you will withdraw everything and never invest anymore. So you need to have a plan. How much are you withdrawing? How much are you leaving in the investments? And how are you planning to continuously grow? Because I mean, if Warren Buffett is still investing to date, almost going to 100 years, it simply means that you never stop, man. Yes, you can get to your target and you retire, but you need to continuously invest so that at least you get to grow your wealth, though you reached your target. So this is very, very important. Your withdrawal, how do you plan on withdrawing, and what is your plan around that is very, very, very important. So yeah, man, these are the 11 steps that you need to follow. You need to start as early as possible so that you get to your financial freedom as early as you can. And it's never too late to start. Don't say because I'm 45 years I cannot do this anymore. You can start now. Yes, you have missed a couple of years, but you can start now, and it can still help you get to financial freedom. Like I said, if a big guy like Warren Buffett, or the investor of Warren Buffett, is still investing into stocks and is a multi-billionaire, you and me can agree that it's never too late to start investing. All of us can invest. All of us can go in the stock market and buy shares, buy stocks, buy ETFs, and still take advantage of the tax-free savings account. This is something that is available for everyone to do. It's not as complex as you think. It's not as complex as they say. It is easy. All you need is a plan. Engage in consistent actions, and you will see your life elevating to the next level. See you in my next video. Don't forget to like this video, subscribe, and once you subscribe, don't forget to hit or click that notification bell if you enjoyed the content that I was giving you about the stock market. I'll see you in my next video, and God bless you all.